Hello, everyone. Good afternoon, and thank you for joining Project Venus Divorce Resource Complex Assets, Divorcing When Owning a Business. I'm Nicole Young, the Marketing Coordinator for Private Vista, and your host for today. Before we get started, I just want to share a little bit about our firm, Private Vista. Private Vista is a financial planning and wealth management firm in the Chicagoland area. We manage approximately $1.7 billion of assets, and for our clients, and we have offices in both downtown Chicago and Oak Brook. We specialize in working with women in transition, business executives, business owners, retirees, families, and qualified plans. Now I just have a few housekeeping items to ensure that you're able to have the best webinar experience. You'll notice that you'll be muted for the duration of the presentation. This is just to ensure that everyone can hear our panelists clearly. If you run into any technical issues, you may reach out to me, Nicole Young, by using the chat box at the bottom of your screen. Any chats that are sent to me will be completely confidential, as it will only be seen by me for today's session. Lastly, if you'd like to submit any questions during the presentation, please email me at pvnews@myprivatevista.com. You'll see the email address throughout the presentation right at the bottom of my box next to my name. That is it for housekeeping. Now I'd like to turn things over to Nicole Romito and Beth McLean.
Good afternoon, everybody, and welcome. Nicole and I co-founded Project Venus, where women in transition are connected, supported, and inspired to enrich their lives through financial planning, education, and partnership. We are both passionate about providing women access to the information and resources that they need to move from a place of feeling overwhelmed and anxious to a place of confidence and clarity. Since we are holding our events virtually, we have opened these sessions to both men and women. So please feel free to share this information with anybody that you know that is either going through divorce or contemplating the process of divorce. Before we start answering questions and do our presentation, I'll just tell you a little bit about myself, and then Nicole will tell you about herself. But my name again is Beth McLean. I am a lead advisor and partner at Private Vista. I have spent my entire career within the financial industry, primarily doing financial planning and investment management. As I mentioned, I'm passionate about helping women in particular, but I have a variety. The women going through transition doesn't mean just divorce. It could also mean that you're becoming a widow or have become a widow, or you're a professional woman contemplating a brand new chapter of retirement. So thank you very much. It's really great to be with you. And I should also share that I do have a CFP. That means that we are fiduciaries, so we have to do what's in the best interest of our clients. So CFP stands for Certified Financial Planner. So Nicole, take it away.
Thanks, Beth. Good afternoon, everyone. Thank you for joining us. Beth and I have very similar paths through our professional lives. We both spent our entire careers in the financial services industry. And in addition to that, we both started out in the banking world. We partnered together on this initiative because not only do we share a similar professional background, we both share a passion, and really what gets us both out of bed every morning and kind of jazzes us up is helping women become empowered around the financial aspects of their life. And we truly enjoy walking side by side with our clients as they are oftentimes going through the low point of their life. And if not, it's certainly an emotional and very difficult time, which makes it very hard to learn about your finances when you're not at your best. But we are there as your partner, not only during your divorce, but to help you ongoing as you do start your next chapter in life. And as both of us like to say, it is a chapter of your life. While it may feel like a very long one and one that's never going to end, you will turn the page and have things to look forward to with excitement and a solid ground of knowledge about your finances, which will allow you to move forward confidently. So I think with that, we are going to go ahead and get started with the presentation. where today Mary Beth and I will be focusing on if you and or your spouse own a business and how to address it and handle it while contemplating or going through a divorce.
So to start with, the first thing you need to just take a step back and say, do you or your spouse own their own business? You could easily, each of you have your own business, or perhaps you have your own business and your spouse might be a partner or an associate in what we would call a services firm, like an accounting practice or a law firm, those kind of things. So that once, and I'm going to go through the different types of corporate structure. I'm going to skip around a little bit because then we're going to talk about what it means if you have other partners and owners, and depending on the structure, you probably do have other partners and owners. So the first corporate structure is the simplest, and it's simply being a sole proprietor. You basically hang out your shingle rather, and it's the easiest type of business to establish. I mean, there's no distinction between the business and you. You have the profits. You also are responsible for all of the debts and the expenses of the business, okay? And I would say that most sole proprietors are people that eventually migrate to another structure. So if you've just started the business and are a sole proprietorship, or it was started a couple of years ago, it could have been that you've now done another different type of structure. The next partnership is the next type of corporate structure. And that basically means that you are in a business with at least one other person. Okay. And the decision-making process, you're generally sharing that jointly. You are also both entitled to the profits, but you're also responsible for the debt and the expenses of the business as well. So I generally, if it's a partnership, we would recommend that there's a partnership agreement. They are not always legally required, but it's a really important document if there is a partnership to really have outlined exactly who does what the responsibilities are. And also, you know, sometimes if one person has been in the business longer and brings in the partner, it might not be an equal share of the profits and expenses. So that's another thing to consider. The next is a corporation, and that's what we standardly think of like a McDonald's or, you know, an IBM, that you basically, the corporation is its own entity and shareholders own different portions of that corporation, depending on what that corporation does and how it was structured when it was started. Those shareholders might not be equal shareholders. But again, the corporations are more complex than other business structures because there's a lot more legal requirements. There's tax requirement. The corporation, just like we pay taxes, the corporation as its own legal entity also pays its own taxes. So it's something to consider. And then the last one, which might be the one most frequently seen if it's a smaller business, is what we call an LLC. And that stands for Limited Liability Company. And it's a cross really between like a sole proprietorship and a partnership, but it's a lot more formal from a legal perspective. There is an agreement that you have to outline, and it will literally get down to who owns what, how the shares go in terms of the profits and the expenses. But the LLC has its own, it basically flows up through your tax return. So just like it does with the sole proprietorship, it's just, it's a little bit different and it's a little bit more removed because it's going to provide liability protection from you, for you and your family, which is why when you started it or your spouse started it, that's one of the reasons that the LLC is so valuable. A lot of doctors are in LLCs, a lot of attorneys and accountants are also in LLCs. Again, because it carves the business separately from that person, but the income flows to the individual. So we're talking about how revenue is recognized. So I'm going to pass the baton back to Nicole.
Thanks, Mary Beth. So when you're looking at how revenue is recognized, Mary Beth talked a little bit about how it works through at the different structure. So your first step, that's why we started with that, is determining, you know, what is the structure of the business. And then this will, as Mary Beth said, it's very common most of the times the structure chosen or that we commonly see is a flow through structure. And that means that any type of income that is net income that is earned by the business is going to pass through proportionately to each of the owners. You'll want to, I think we want to kind of take a step back, is if you and or your spouse own a business and or are an equity partner at a professional services firm, you're going to want to ensure that your attorney has experience with this type of asset, and in addition, have a certified financial planner and most likely a CFP on the team, so that you have the people who are very knowledgeable and used to looking through financial statements and tax returns, because this will flow into the topics that we're going to talk about today. And if you are in some type of LLC, the limited liability corporation, or a partnership, or an S corporation, the owner is compensated very differently than if they were an employee of the firm. Oftentimes what we'll see for the LLC, the sole proprietorship, and a partnership is that the owners will take, there's a few different words, but some people call it a salary. It technically isn't. It's actually a guaranteed draw. And what that means is, obviously when the business is making money, selling things, money's coming in, there's expenses going out, you truly won't know what the net income or net loss is for the business until they close their books for the year. But clearly everyone needs to be able to pay their bills throughout the year. So, and if it's an established business, the owners will have an idea of what they generally have generated as profits, and then each of them will, according to their ownership, be able to take what's called a guaranteed draw. And oftentimes that's distributed to the owners on a monthly or perhaps bi-weekly basis. And this allows them and their families to be able to pay the bills throughout the year. And then oftentimes we'll see, but not all the time, there'll be 4 additional distributions which are made to the owners, and that is so they can pay their estimated income taxes for the year. Because again, if there's not W-2 income, there's no way to withhold, and the IRS wants to get some type of tax revenue throughout the year. So that might be a part of your cash flow. And then last but not least, if after you take all the revenue, all the expenses, any distributions or draws that were made throughout the year, if there's money left over, that's a profit. And there could be an additional distribution that will come out, and it will be, all of these things will be coded, or you'll receive different types of tax forms dependent on the structure of the business. So you may still get a W-2 for a portion of your income. Everything may flow through on what's called a K-1, or you might get a 1099. So we reference those specific documents is as you're starting to gather information, and or as your attorney's requesting information. The key thing you're going to want to get with the tax return is, with your personal tax return, you're going to want all the schedules and statements. And then you're also going to want to get a copy of the business tax return as well. Because as Mary Beth mentioned, oftentimes the entity itself will not pay taxes, but they still need to prepare a tax return. And this will help you and your team of professionals start to do, if you will, put on your Nancy Drew hat and do your detective work to start understanding what's coming in, what's being paid, and then, what has historically been either the profit or loss of the business. The only other thing I wanted to mention at this point was sometimes you may hear the term of phantom income. And what that means is the business, the owners may decide not to distribute all the profits. And so they would keep the money in the business, and Mary Beth's going to talk about that in detail on the next slide. But I just wanted to mention it here, and again, why you may want a certified financial planner and a CPA on your team, because there's very different and very legal reasons of why taxable income will be one number, and then when you're, depending on what you're trying to calculate, the actual income of the business or distributions may be higher or lower. So we're not saying anything devious is going on, but you're really, because this drives so many components of your marital settlement agreement, you're really going to want the team to understand how to get at what the actual income is. All right, our next slide. Okay. I will talk about our appraisals, and then I got a little out of order, and then Mary Beth will certainly go into more detail on the retained earnings and income and things like that. So with the business appraisal, an appraisal is simply, it's how you value an asset. Many of us are very familiar, especially over the past few years, of getting our home appraised. So if you have a mortgage, you could refinance at a lower or more attractive rate. Kind of bottom line, the business appraisal is the same thing. You're valuing what either the entire business is, if you and or your spouse are the only owners, or as Mary Beth referenced, perhaps they're a partner in a physician's group or at a law firm, and they are one of numerous owners. Their share still has a value. And oftentimes what we see, the business is one of the larger assets that's in the marital estate. If you are not going to be selling or dividing the ownership of the business, you're most likely going to want and need an appraisal. And one reason being is, let's say that you are the one who's in the business and your spouse is not involved at all. It would make sense you would retain the ownership of the business because you're the one who knows how to run the business, what the business is all about. And if you have partners, it's highly unlikely that your partners would want to be in business with your soon-to-be ex-spouse. And therefore, the value of the business would go on your side of the balance sheet or in your column when you're allocating assets. And let's just say your share of the business is worth $1 million. Your spouse will need to get, depending on how the total estate is going to be allocated, but they're going to have to receive what's called an offset or other assets that would be, equal value or get them enough value to add up to how you are dividing your overall marital estate. So for example, let's just say you're going to divide the overall assets 50-50 and your value of the business is $1 million. Your spouse will need to get other assets that are worth $1 million. Very high level. You'll of course need to take into account taxes, unrecognized gains and things like that, but just wanted to at least explain why you would need the appraisal. The other thing is, how do you value a business? Again, generally speaking, Mary Beth and I like to try to avoid always or never. So generally speaking, you are going to want to hire a professional who does business valuations for a living. There are different accreditations, which we'll talk about later in this seminar. But again, sometimes depending on the business, the CPA may be able to do it. There's a whole host or variety of methods that can be used. And we're not going to get into the different ones today because that could be a whole week's webinar. And it really is going to be dependent on the type of business structure, the industry that you're in, the accounting method that's used. Are you cash-based? Are you, mostly billing-based? So there's a whole host of varieties. And we mention those now because really what it will say is you really do want to have someone who knows how to do this and that they do it on a regular basis. And then the only other thing I wanted to add before I'll pass it back to Mary Beth is these are not inexpensive. So I started this topic with a comparison to a home appraisal. These cost much, much more. The range is pretty wide. The least expensive I've seen is $5,000, and we've both seen them go up to tens of thousands of dollars, $50,000, $75,000 for one valuation. So we highly recommend that you have a strategy with your attorney about how to treat the business, because those fees typically will come out of the marital assets, and then that's less money for you and your family at the end of the divorce. And if you can't agree on the value, or you don't have kind of a well thought out strategy, unfortunately, you might end up with dueling experts. And that means that each side, you and your spouse, each hire your own business valuator. They're both doing a full valuation, so they're both going to need to get paid. And what we'll see is the person who's keeping the business wants to have a lower valuation, and the person who would be getting bought out or receiving an offset wants a higher valuation. So it's not unusual to see a disparity between the two values. And if you cannot come to an agreement, you would have to go to court for the judge to rule or decide. And oftentimes they might just take an average and split the baby. Okay, so now with that, Mary Beth will get circle back on the more detail about our cash flow and the other items we've lightly touched on.
So one of the things about business income, I mean, in a simple accounting phrase, it's all the income that's generated from a business, less all the expenses that are incurred, and then that should be your gross profit. But what happens a lot, and it doesn't really matter what kind of structure the business is in, but the personal expenses can be basically run through the business. Because, for example, if you are the spouse and you have to carry samples and you go all over the Chicagoland area, for example, and you need a car in order to do that, you can expense the car through the business because it is necessary. So when people put personal expenses through the business, it's not illegal. We see it very, very often, but there's a fine line between what is considered to be personal that is also kind of also business. So, I mean, taking, for example, if you and your spouse, you had to go on a trip and you decided to take your spouse with you, the business would be able to pick up your ticket, but maybe not her ticket. So again, it's all of those things that get, and I know it sounds like a lot of minutia, but if it's been supporting the lifestyle, you need to understand exactly how it was supporting your lifestyle. So understanding what personal expenses were being run through the business is really very critical. Distributions, they can be taxable versus non-taxable. So as Nicole mentioned, a K1 is, you get that and you may or may not have gotten any cash distribution from it, but it's still taxable to you. So you have to understand, again, what kind of structure you have, how the business earns its income, what expenses, and then how it's going to flow up either through the business or to you personally. The other thing that's really important in businesses is retained earnings. Retained earnings are basically that income that has not been paid out by the business to either the owner or the shareholders or the partners. And the reason they'll do that is that they either want to reduce their debt load. If they bought a building and they've got a mortgage, they might want to pay down on the mortgage. If they have a bank loan, they might be paying down the bank loan, or they might want to be buying a building and are kind of keeping that money in the business to provide the down payment. It could also be as simple as that you're going to need all new computers. So retained earnings are kind of like what what the business does in order to keep building. It's kind of that rainy day fund that allows them to do whatever they need to do to expand. And then the other thing that we get very, very often is about fluctuating annual income, because especially with the pandemic, to say that there was an economic disruption is an understatement. So, but maybe you had a business that was doing really well in 17, 18, and 19, and then 20, not so well, 21 coming back a little bit, still not where it was in 18 or 19. Well, what will happen is that obviously that income is fluctuating, and it's really important for you as the spouse to understand what the income levels were for the business, because generally what they'll do is they'll go and take an average, especially if the business was it was simple, not simple that it was economic disruption because of the pandemic, but it would be a simple calculation to say, we looked at the last 5 years, we feel that to take an average of those is really reasonable. Because as Nicole already pointed out with an appraisal, right, the person that is going to be bought out of the business wants the higher one. And the person that's going to stay in the business has to buy it wants the lower. Well, the same thing with income. And so they would want that the annual income is actually lower, but that's not the case. So don't be too overwhelmed if your husband or your spouse says the business isn't doing very well, so it's not going to be the same as what you thought a couple of years ago. They're going to go back and ask for history if that is truly the case. So, and again, it just underlies why you need to have a team of professionals that work together, understanding the investment, the taxation, and what the business structure is. So, so thank you. I'm going to hand it back to Nicole.
Yeah, and this flows nicely into why do you want to know or need to know what the cash flow of the business is if there is going to be maintenance, which was formerly known as alimony or spousal support. And then if you have children who are not at the age of majority yet, so here in Illinois, under 18 or up to 19, if they're still finishing high school, this is how you'll calculate the child support. To add on to what Mary Beth was saying, we do want to reiterate that there are, certain expenses or deductions or things that are taken on the tax return, which are completely legal for tax purposes. But when it comes to calculating income for maintenance and child support, at least here in Illinois, we actually have statutes and guidelines that the state has created. And one of the things that Illinois has said is when it comes to child support, and again, you'll hear your attorney say this, you'll certainly hear Mary Beth and I say this, it depends. Because the guidelines are just that, they're guidelines. And there can be reasons to deviate from them, both upwards and downwards. And the guideline around how is income calculated is a little vague or ambiguous. It leaves itself open to interpretation is a better way to categorize it. And so right now, what it says is you would take gross revenue, so any revenue that the business shows coming in, but then you would subtract what the state calls necessary business expenses. I think if we went around this call and we said, well, what's necessary? If we had, if there's 25 of us on the call, we'd probably have 27 different answers. And so there's certain expenses that they did spell out. So to add on to what Mary Beth was highlighting, if you use your car for business purposes, you're going to be able to take some type of deduction or expense against income for it. When you're calculating child support, again, in the state of Illinois, that's going to get added back. So if your business revenue, I'm just going to make this easy for the math, is $1,000 and you were able to deduct $500 for your car expense, your taxable income or net income for tax purposes would be $500. For starting to do child support, you would add that back and you'd be back up to the $1,000. And there's some other things they spelled out, such as housing allowance and reimbursed meals for the parent. But again, a lot of this is going to depend on the business. What's necessary to run a restaurant is going to be very different than a law firm and things like that. So I really just want to echo what Mary Beth said a little bit ago, is the more information you have, while we understand it can be very overwhelming, especially if you're not involved in the business, it really will help you and your team build the case or build the support for, how are we understanding what type of possible maintenance and child support we should be, strategizing for. Let's see. Oh, the other thing I just want to add on is Mary Beth talked about fluctuations already, so I won't repeat that. But the other thing we've seen as well, again, because there is the very legal thing of there's the income and then there's taxable income. Another thing that your team will look for is if there is very low income, even on the financial statements or taxable incomes, they're going to compare and contrast that to your balance sheet. So is the business generating very little income, but you own 3 homes? You have 2 children who have been going to private school, K through 12, or you're easily writing checks for an Ivy League college and you're not taking loans or taking it out of a 529 or other account. So there are ways to kind of fit together the various pieces of the puzzle to say, okay, you're saying your business is generating $500,000 of income a year, yet we're looking at the mortgages on your home, the expenses that you're using to support the life, and it's just, that's running at $1 million a year, yet you're not taking on any debt. So there are ways to kind of, put the pieces together and try to figure out what's really going on. And then the last thing I'll just hit on lightly is with maintenance and child support. Generally speaking, most people know that would be a monthly payment. Back in the day, you used to receive a check. Most of the time now it's direct deposit to your bank account. But we've often seen where the person who will be paying the maintenance or support would rather just be done. It doesn't mean they don't want to meet their obligation. It's just that instead of having to make the transfer every month or have that on their expenses every month, they'd rather say, let's just do a lump sum buyout. And so if what we can do is we can figure out what would be the present value of that future income stream. So if you were going to be receiving $5,000 a month for the next 10 years, we can figure that out. How much money would you need today and have it, invested and earning an assumed rate of return to be able to fund that type of future cash flow? And so you're still getting your money, but you're getting it today over a period of time. And there's pros and cons with both approaches. The pro is you have your money in hand today. So if the business continues to not do well, maybe they don't reemerge from COVID, you've got your money. There's no clawback or a refund, if you will. On the other hand, if you take your money today and the business does even better than anyone anticipated, you don't get to participate on the upside. So this is one where Mary Beth and I certainly see the emotions come into play, and it's a difficult decision. But again, we, along with the rest of your team, can help you weigh the pros and cons and help you make an educated decision.
And that also applies to just tack that on, is to, if you're the person that will be either being bought out of the business, it could also be that you get a lump sum payment, based on what your assets are. Or if the business can't support that, we have seen it where it's structured where there is a note that is paid over time too. Very similar to what Nicole is talking about, but it would pertain only to the buyout of the business piece of it. So again, lots to consider, but again, having the team with you to kind of guide you through all of the different decisions that you have to make is really important. So the financial professionals that we recommend are people like Nicole and myself. As I mentioned at the beginning of our webinar, we are both certified financial planners. And that means that we all had to take a test, and we had to pass certain competency courses, and then you take a test, and then there's ongoing education as well. I actually have my MBA, and Nicole, in addition to being a CFP, is a certified divorce financial analyst. So I'm going to let her talk a little bit about what that does.
Oh, sure. This is an additional designation that solely focuses on the world of divorce and the tax laws, some of the processes, and things like that. Oftentimes, when people are operating solely as a certified divorce financial analyst, they're more transaction-based. So they would help you through your divorce and help you with the financial decisions of the divorce, but they would not work on going with you like Mary Beth and I do. And certainly it's a more laser focused part in the financial world.
More finite, the services that are provided.
Yes, that's a great way to describe it. Thank you.
And so you're going to talk about CPAs, forensic accountants, and we already talked about business valuators.
Oh, okay, sure. So the CPA is another designation, certified public accountant. And they generally focus solely on the tax aspects in the world, whether it's divorce related or not. They can help on the individual side and or on the business side as well. So they're going to certainly be very helpful in being up to date on the latest, what the current tax laws are on the book, and then keeping their finger on the pulse of what potential changes could be coming down the road. The reason Mary Beth and I like to focus on, well, actually, you know what? I'll take a step back. I'll explain forensic accountant and then let Mary Beth kind of tie it all together. So just as Mary Beth highlighted that financial advisor, there could be some area professionals who have a finite focus in that. The same thing with a forensic accountant. They may or may not be a CPA, but they're certainly going to have an accountant and tax background, and they're going to have a finite focus where if you are trying to, if you believe money is being hidden and or has been spent for non-marital purposes. So for example, perhaps your spouse has a gambling problem or a drug problem, and monies that were marital monies, so they would be for the use of both of you, were used for non-marital uses. And the other time we'll often see this come up is if there is a paramour in the picture. So again, if trips were taken, but it wasn't with the spouse or the family, things like that. So they would focus on really digging into the bank statements, the credit card statements, things like that, to determine if money was used for non-marital purposes or it's being hidden so that it's not counted as a marital asset. So Mary Beth, with that, I'm going to let you add on to that if you'd like, and then of course tie it all together.
No, you've done a great job. And I guess I would just say what the focus of the forensic accountant, even though it's finite, is to make sure that there's no assets, marital assets that have been spent outside the marriage, whether they've hidden money, whether they're spending money, either, as Nicole pointed out, gambling, drinking, or on a third party. It's that person is going to help you kind of put all of the flow chart together about when the money came in and where it went. And hopefully your spouse, if you're going to go through the divorce process, we're going to actually have a webinar next month about which the different processes to go through, the different procedures. But if you have a spouse that's cooperating, hopefully you don't need a forensic accountant because both of you are forthcoming. And then we've already talked about the business valuator and what they do and the expense. And so again, hopefully if you're cooperating, you both agree that whatever, so you don't need to do two of them. So if you do have a business, whether you have it or your spouse has it, it would be a really good idea to at least agree on only doing one business valuation. And you know what? I would go back and say your spouse or you may have already done a business valuation for insurance purposes or estate planning purposes too. So if you've gone through that process and you just didn't maybe remember it, that would be another place where you could start to get a business valuation. And if it's old, then you can consider whether or not you really want to pursue a course of action where you hire a business valuation or business valuator to do the valuation. But again, talking about that with your attorney and your financial advisor and your accountant is really very important to help you make the right decision. Because Nicole and I always like to say, do you want to send your professionals' kids to college or you want to send yours, right? We're not in the business of having you spend dollars that are not going to help you in the next chapter. We believe that anything that you incur with regard to an expense for the divorce should make your life better in the next chapter.
Okay, so just to kind of the key wrap up here, sorry, I'm trying to get my mouse, okay, is a lot of this we've already highlighted, but if you kind of the key takeaways is, as Mary Beth just mentioned, the valuation, it's, you know, it's not as straightforward as appraising a home. It's oftentimes very expensive. The transfer of ownership is not always possible. So again, if you and or your spouse there's multiple owners of the business, or you know they're in a partnership, that may not even be possible. So again, that's something you want to talk about sooner than later, because that could dictate then our valuations needed, how do we want to proceed, things like that. It's perfectly fine, legal and common to be commingling your personal and business expenses, but you're going to need to understand how to separate those for purposes of the valuation of both the business and what is the actual cash flow in the context of divorce. And, you know, these businesses are illiquid. You know, while you could, for cash, you can go to the bank, you can get the money out the same day, no tax consequences. You have an investment account. You can generally, I mean, you could, there are ways to get the money the same day. Under normal kind of, if you know ahead of time, you can get your money within about 3 business days, possible tax consequences. With the business, if you're needing to get money, a sale takes a long time, even if it's a very attractive business in a very attractive industry or geographical area. There's a lot of due diligence and attorneys are involved and things like that. So it takes time to sell a business. And then also too, if you're trying to get excess cash out of it, there's a lot of competing priorities and a lot of different people around the table who would have to agree to that. So illiquidity doesn't mean it's a deal breaker, but it's something to be aware of when you look at all the various assets in your estate and what you need to be able to maintain or sustain your desired lifestyle post-decree. Which means, sorry, after the divorce is finalized. Okay. I think with that, unless Mary Beth, did you want to add on anything? I think we can go to questions.
Nope, I think we've covered most of it.
Perfect.
All right. Thank you, Mary
I guess
Beth.
we covered most of it at the 50,000 foot value, right? Because there's so much more. Each of these individual topics like retained earnings and business valuations, we could probably talk and fill an hour on just those particular topics, but we wanted to just highlight what you need to understand if you're going to go through the divorce process and either you or your spouse owns a business.
All right. Thank you, Mary Beth and Nicole. As it is 12:45, I think we have time for maybe 1 or 2 questions. So let's just dive on in. I have a couple here. So let's start with, what happens if I can't get the financial information?
Mary Beth, you want to take that one?
Sure. If you can't find the financial information, we always recommend that you do a couple things. The first is get a copy of your tax return. There is a wealth of information on that tax return because it's going to tell us what the kind of business structure is and how it's flowing through you personally, or if it is flowing through you personally. And it also is going to give us an idea if there's investment management accounts, because you're going to have to list what the dividends and interest and income or gains that you have from those particular accounts. So that would be the first place to start. And we have had clients that say, you know what, it's been such a long time, I really don't even get involved in the filing of the tax return. Get the name of the CPA, because the CPA, if you've been filing jointly, that CPA represents both you and your spouse, and they should be able to provide you a copy of the tax return. So right now, if you did an extension for 2020 coming up on October 15th, you would have that completely done. Well, it'll be done by October 15th. So, but that's the first place to start. And then I think Nicole already referred to being a Nancy Drew for yourself, and that's being able to start keeping, you know, if you see statements that are coming through the mail or that kind of thing. So I just think that you really have to just start thinking small, like finding out what your real estate taxes are. You can call the county and tell them that you live there, and they'll probably need to get some verification as to your identity. But all of those things, they can be found out. They don't need to come from your spouse. Ideally, if you're cooperating through the process, they are sharing that, but don't be afraid to know or understand rather that you can get that information. And again, working with your team, we can walk you through the different ways that you can get that. Nicole, do you want to add anything?
Yeah, I think I just have 2 points to add on. As you are gathering the information, whether you're making, you know, hard paper-based copies, or if you're downloading statements or things like that, or scanning, we both suggest that you keep the information outside of the home if you're still cohabitating or living together. So whether you want to, you know, put it on a external jump drive, or you're making copies, you're going to want to store it with a trusted friend or family member, or if you work, keep it at your work desk, things like that. Because as you're accumulating the information, you want to make sure that you're also keeping all of it. And the other item is, I agree with Mary Beth that certainly the CPA or your financial advisor, that you are their client as well, and they have a duty to you as well. However, if you're in the contemplating stage and you haven't talked to your spouse yet that you're thinking about divorce, or if you want a divorce, just be aware that you certainly can call and get the info, but they most likely are going to then tell your spouse, hey, Nicole called me today. Now, you don't need to tell them you're getting a divorce, but if you've never been involved in the matters and all of a sudden you're showing interest and acting for information, you possibly could be tipping your hand to your spouse. And we just both want to make sure you're prepared and ready and have the conversation on your time and your terms.
Great suggestions.
All right, thank you for those answers. Let's move on to, I think, at least one more question. I think this one's really, really interesting. Won't my attorney handle all this?
Go ahead, Nicole.
I'll
at the end.
Yeah, please do. Yeah, Mary Beth and I hear this all the time. You know, hopefully your attorney's a smart person. There's a lot of smart attorneys out there. But generally speaking, most of the attorneys we know did not do any type of business degree as an undergrad. And there really is not a lot of, they maybe took a business tax course, or there might have been a tax law course as part of their legal program. And I'll flip it on the head to, at least for Mary Beth and I, when we were in undergrad, you know, we only had one law course. So we both had a semester of business law. So we're just saying, you know, it's the same. We're not being disparaging. And so there are attorneys out there who also do have like a master's in taxation from the legal perspective. But again, when you're looking at this, and if you were not involved in the finances, you're going to want someone such as Mary Beth or myself and an accountant, perhaps some of the other financial professionals on your team, because this is all we do day in and day out. We're both very comfortable looking at a tax return, looking at investment statements, reading stock option grant packages. That's what we do day in and day out. And it's very important that as you're looking at assets, in particular for today, the value of a business, if it's valued at $1 million, that's kind of just on paper, because most likely there's going to be tax consequences that will be embedded in it. And what that means is they wouldn't have to be paid until the actual business was sold, but you want to take that into account when you're looking at all the different assets. What are they worth today? Fair market value. Are there any unrealized tax consequences? How are those taxed? And what does it mean when because you're going to be splitting your taxable entity as a marriage as well. You'll be each being filing individually going forward. So that's why you'll want to have the right financial people on your team as well. Mary Beth, anything you'd like to add?
I agree with you 100%. It's not that, and I would also say again, your attorney's job is to take you from the beginning of the divorce process to the end. And they do that very well. And they're your advocate legally, but we become your advocate financially for what happens after the divorce. We hear so many times, oh my gosh, it's all the work is over. And we say, well, that work is over, but there's more work that needs to be done so that, again, you can get to the point where you are financially savvy and independent and making choices for yourself for that next chapter. So, and the attorneys don't get involved in that. And we might need another type of attorney, for example, an estate planning attorney, because if you did do estate planning while you were married, those documents need to be amended and changed. So those are the kind of things. So, but that's why we have a team. So bringing in an accountant, an attorney, and an advisor, the AAA team, we call it, is basically always a good idea, because we can go help you make decisions about what the financial impact will be for you, and then guide you after that. So we do this, as Nicole mentioned, we read a lot of different documents every day, but we work with different types of attorneys and accountants every day as well. So again, we become your advocate, because sometimes it is overwhelming, it's confusing, and we don't mean to, but all three professions might talk in jargon sometimes. So we want to always, our job is to make sure that you always understand what is being presented, what your options are, and then we make recommendations thinking about what we think is best for you. So do we have time? Maybe it's 12:54, I don't know.
Yeah, I was thinking since it's almost 1 p.m. that maybe we just get ready to wrap up here. So before we do, I just wanted to say thank you to you both for your insight into this incredibly complicated situation. But before we finally wrap up, Nicole Romito wanted to share some closing thoughts with us all.
Well, Mary Beth and I would like to thank all of you for your great questions. We hope that the knowledge that we shared will help ease your mind and you feel better equipped to move forward on whatever path is best for you. If you would like to have a complimentary 30-minute consultation with one or both of us, our contact info is up on the screen. So please feel free to reach out to either of us, or you can certainly reach out to Nicole Young. We're happy to, have the conversation and share any other advice that might be a little more specific to your situation, or if you're looking for a referral to any of the professionals we talked about today. We'd also like to invite you to our next Project Venus event, which will be on Wednesday, October 13th. And this is part of our divorce resource series. And this one in October will focus on choosing the right path for you and your family. And we'll be joined by a family law attorney and also a therapist who focuses on working with people going through a divorce and is also a divorce coach. And obviously, Mary Beth and I will also be there. And we've been talking a lot about the team. So you'll be able to get different information from the various professionals that represent the different aspects of your divorce. And we'll be talking about the different ways or processes that you can use when going through a divorce, because there's more than one. And depending on your situation, we want to educate you on the options so you can make an informed one. And then our next divorce resource is around a popular topic around the marital home. Should I stay or should I go? And Mary Beth and I will be joined by a realtor or real estate agent who focuses on working in the area of divorce, and then also a mortgage broker who also will have a lot of specific knowledge around the mortgage loans and, tips and things. There's definitely specific info you want to know in order to be able to qualify for a loan and things like that. So again, our next two are October 13th and November 10th, and they will both begin at noon Central Time. And with that, we want to thank you for joining us. And again, if you have any questions or would like additional information, please feel free to reach out to either of us. Other than that, please enjoy the rest, if you're in Chicago, this beautiful sunshiny day.
Right.